trying to stick it to the government kind of mentality, and I'm going to get what's mine because, it may not be there for me in the future, or I want to get all I can out of the system, or whatever it is.
It's funny, Ryan, you mentioned that we have had, when we talk to people, them saying, I want to stick it to the government, take my money today. But if you really want to stick it to the government, you claim later, get a higher monthly check, and live longer. That's how you stick it to the government.
Welcome to Redefine Retirement with Ryan Wheless, powered by Ally Wealth. This podcast explores how to live a limitless life of abundance in retirement with clarity, purpose, and confidence. Welcome to Redefine Retirement with Ryan Wheless. Today, I'm joined by Jason Fichtner, policy fellow at the Stanford Institute for Economic Policy Research. Let me just tell you this, folks. This guy I'm bringing on the show today is one of the most valuable people I've ever talked to about retirement income, the direction of Social Security, how Social Security benefits should be claimed, whether they will be there in the future. This guy is so good, he helped bail out the bankruptcy of the Puerto Rico pension fund when Puerto Rico went bankrupt. All right. This is an episode you don't want to miss. Please stay tuned as we join Jason with the show. So where are you from? Where are you at right now?
Right now I'm on Capitol Hill in DC, which
oh wow,
which means the government's back open today for the first time in 41 days. So
yeah, that's been an interesting thing. We had people calling the office, and had a lady die actually. Her husband died, and she was trying to figure out the Social Security benefits and was trying to call Social Security, but they were closed.
Yep. You have to go through an AI system first, which creates a bigger backlog, and they will call you back if you have hours or days to wait. It's a very big problem that the commissioner is going to have to solve quickly.
Well, the good news is that she's retired and has plenty of time. So that's the good news, right?
Always try to find that silver lining, right?
Yeah. So Jason, you've done some incredible work, my friend. I mean, let's give my listeners here and viewers here a little bit of background on yourself, bud. Can you kind of talk about your accolades and what you've done in the past and kind of where you are today and doing what you're doing?
Sure. I'm one of those people who moved to DC, and my joke is I'm on the 32nd year of my 5-year plan in DC. I figured I'd come here for grad school. I grew up in Michigan, went to University of Michigan for my undergrad, went to Georgetown for my master's, and Virginia Tech for my doctorate. But I figured I was going to come here, spend some time, and then go out to Colorado and be a ski bum. And I hope at some point to retire out to Colorado and would live that dream. But you spend time in a city, you put roots down, and I've had a long career here, both academic and practicals. I call myself a pracademic, a practitioner academic. And I've worked at the Treasury Department, the United States Congress, at the Joint Economic Committee. I've worked at the Social Security Administration, which for your listeners is probably important because I was the Deputy Commissioner, which is the number 2 position, and also their Chief Economist. I've worked at think tanks like the Mercatus Center at George Mason University. I've taught at Georgetown and Johns Hopkins economics classes. And then currently, I serve in several positions sort of around the horn. I'm the executive director of the Retirement Income Institute for the Alliance for Lifetime Income, which is now under LIMRA. I chair the Puerto Rico Pension Reserve Trust, which we can talk about, which is kind of interesting. And I serve on a variety of boards, including the FINRA Foundation Board, the National Academy of Social Insurance, and I keep academic ties with policy fellowships at Stanford and Washington University in St. Louis.
Wow. So look, I got to know, I mean, all this work you've done, all these accolades you've earned, the teaching and and I believe you're a PhD as well. I mean, what drives you? Why do you do what you do?
It's an interesting thing. You don't want to give like the cheesy answer. I'm here to help people because I'm a PhD. I'm a doctor, but I can't help people. That's kind of the joke for PhD.
Well, if you tell me you're here to help people, I'm going to go ask you why.
So what sort of drives me is the solvable problems, which we can identify, we can solve if we just have the political courage to come together and get it done. And that's what brought me to Social Security reform in the first place, and also brought me to work on retirement income, because of the shifting demographics and shifting needs away from our current model where people had Social Security and a defined benefit pension plan. Now they've got Social Security and a 401k plan. And they're no longer getting that stable income from an employer pension. They're on their own with a 401k plan. And how do we help them recreate that income they need that's protected in retirement? And then with Social Security, there were just some little things that really drove me nuts, Ryan. They're still today, but we're trying to change them. We talk about Social Security claiming. So you talk about trying to get a hold of a claims representative at Social Security. The number one transaction Social Security does is a replacement Social Security card. You get married, name change, you lose it, you need a new card. the number one question they get is, when should I retire? And what was happening when I was at the agency is people walking in and they saw that age 62 is called the early eligibility age. No one ever told them it was a reduced monthly benefit. Never told them that benefit was going to be reduced for the rest of their life. What the agency said instead was, if you take it at 62, you'll get smaller paychecks, but for a longer period of time. In fact, you'll break even in 14 years. So you're ahead if you claim today for 14 years. Never telling people if they live past 14 years, they're then behind for the rest of their life, when that money is more important. So I got into really the idea of how you do narrative framing to change policy, which changes behavior to change retirement security.
Well, now that you said it, the Social Security thing is very interesting to me because I deal with a lot of engineers. I'm in Houston, Texas. When we serve the entire country, but in Houston, we're based in the Woodlands, Texas, and we have the Chevron, Exxon, BP, the largest oil companies in the world. In fact, I often call Houston the Hollywood of oil. All right. And what's really interesting to me is the engineers that I work with. And they all come in with this break-even analysis, right? And they've got it down to the penny. And I just always ask them, listen, does that include your wife outliving you? And does it include the taxes that you pay on Social Security? And they look at me like, well, no. I'm like, well, isn't that important? Right? Because to me, the survivor benefits of Social Security are almost as important as the primary benefits the person claiming for the Social Security is going to get, right? Would you agree with that?
Yeah, definitely. And one of the things too, Ryan, which we talk about Social Security, we often don't mention what the technical name of the program is. It's OASI, the Old Age Survivors Insurance Program. So what people don't realize is that Social Security is an annuity. It's the biggest annuity plan out there. It's inflation protected. It lasts the rest of your life, but it has those survivor benefits and spousal benefits. And it's important to think about that insurance concept because people think about, well, how do I game the system to maximize my lifetime benefit instead of thinking, how can I minimize my risk in retirement without leaving my savings and making sure I have income in retirement that's protected when I may need it most, and my spouse and my children, et cetera.
Yeah, it's interesting. I have a guy recently retired, and 62 was his retirement age. Okay, and the moment he turned 62, he filed for Social Security, and I begged him not to. And the reason why I begged him not to is his wife is 52, and I said she is going to outlive you, sir, and you're depriving her of a much larger Social Security check that she could have at age 70. That's inflation adjusted for the rest of her life. It would be much, much greater income for her later on in life.
Yeah, no,
he was the cat. Go ahead.
You're exactly right, Ryan. That's exactly the right way to frame it. And one of the things we've been doing now is telling people, think about how you talk to clients. If you go in and talk about the early eligibility age, 62, like no one likes to be late to their benefits. They want to claim it as much early as possible. Sure. Give it now.
Am I leaving money on the table? I mean,
Exactly. That's what the mindset is. 67, we call the normal or full retirement age. But what's normal about 67? What's full about it? It's not full. Full means you can't pour any more in. But if you delay claiming to 68, 69, 70, you can get more. So why don't we talk about everything being a penalty below 70? Age 70 is sort of like this target date. Anything below 70 is a penalty. There's a bill in Congress pending called the Social Security Clarity Claiming Act, which would change how Social Security talks about the claiming ages. 62 would no longer be the early eligibility age. It would be the minimum benefit age. 67 would be the standard benefit age, and 70 would be the maximum benefit age. So imagine, Ryan, a client comes into you and says, I want to claim Social Security. And you say to them, do you want your minimum monthly benefit or your maximum monthly benefit? That's going to change the very nature of the conversation.
There's a lot of Social Security planning software companies that will be out of business the day that happens.
Well, that might be a good thing, right? Because people are trying to, this is where the financial advisors can really help people understand the benefits of delayed claiming if they can afford to do so, but walk them through those strategies and try to show the protection that Social Security can give.
It's interesting to me too, Jason, that the number of people that don't think about the long-term impacts of the residual value of your portfolio based on when you claim Social Security benefits. So if you're somebody who retired at 55 early, maybe you should claim it at 62, right? Because you reduce the pressure of your portfolio having to produce that income up until age 70. So maybe do take it at 62. But if you're someone retiring at 65, you've got a year and a half in most cases, right? And then it's only 5 more years to get to age 70. So shouldn't you retire with enough assets to where your portfolio funding the entire brunt of your lifestyle income that you need, right, to get you to Social Security shouldn't be able to do that? And it's just some basic math that folks can walk through. But man, I'm grateful to see that we're getting away from that break-even analysis. I got to get, the trying to stick it to the government kind of mentality, and I'm going to get what's mine because, it may not be there for me in the future, or I want to get all I can out of the system or whatever it is.
Yeah. It's funny, Ryan, you mentioned that we have had, when we talk to people, I'm saying, I want to stick it to the government, take my money today. But if you really want to stick it to the government, you claim later, get a higher monthly check and live longer. That's how you stick it to the government.
That's exactly right. And what's really interesting to me too, Jason, is the people that I serve at Allied Wealth, one of the most common questions I'll ask them is what is your greatest concern? And I will tell you, 7 or 8 out of 10 times, it is outliving my money. Fear of living too long, my resources not lasting as long as I do, and dying broke and destitute, that sort of thing. And so the other part of that is that the biggest threat that people have today is living too long. Our generation, your generation, I'm not sure your age, but I'm 48, not sure yours.
I'm 54.
You're 54, so we're not far apart. But, the people that I serve, 65 and 70, are going to live the longest in history of any generation, right? Yeah. So if you want to get the most out of Social Security, do what Jason just said. You take it at 70 and live a long time. And that's what people are facing with right now.
Yeah, that's exactly it. And you made a good point, Ryan, about talking about putting pressure on the equity portion of a portfolio to fund income. One of the things, again, the framing I like is income is the outcome in retirement, right? You're trying to basically recreate in retirement that paycheck you got while you were working, because economists call it a budget constraint, right? You basically sit down with the client and say, how much can you spend? Here's your budget. How do you get that budget? Social Security, protected income, or you're drawing down from your assets. But people do not like spending out of savings. They hate it. They see that drawdown going and they get very concerned. But they're okay spending out of income. So one of the things we advise is thinking about how to use that asset base up front to generate some additional income on top of Social Security, like a bridge annuity to help defer delayed claiming of Social Security, or providing a lifetime annuity, so that provides the essentials people need and some additional income. And they'll let the rest of the portfolio rest. And that can be things they can use for others and that don't have to worry about that too much.
Well, Jason, I think what happens is, there's a really large company out there called Fisher Investments, for instance. All right. And they have your money, all of your money, invested the same way. And I don't think that's the way it should be. I think buckets of money, or whatever you want to call it, should be there doing different things. So if you need $70,000 a year coming in to cover your food, water, shelter, clothing, access to healthcare, transportation, and utilities, I don't think you could have any quality of life whatsoever in retirement if you don't have those basic expenses met, right? And that number's $70,000 a year. Okay. Let's say you got $35,000 a year coming in from Social Security. Well, that means you've got a $35,000 a year income gap. All right. So if you had to have food, water, shelter, clothing, access to healthcare, medicine, transportation, and utilities covered for the next 30, 35 years, okay, how much of that $35,000 gap do you want to have guaranteed to you as long as you have breath in your body? Yep. And Jason, every single person tells me, yeah, all of it. Well, the only way I know to do that, there's 2 ways you could, okay? The most common way is an annuity, all right? So should you carve out the least amount of money possible out of your portfolio, get it out of equities, get it out of bonds, get it out of real estate, get it out of, gold or whatever, and put enough money in a income bucket that guarantees you that gap for as long as you have breath in your body. So you don't have to worry about it, regardless of what happens with the stock market, the economy, interest rates, politics, wars, famine, COVID, whatever.
Yeah, no, you're speaking my language, Ryan, because this is one of those things where when we talk about portfolio allocation, there used to be you do a 50-50 equity bond, 60-40. Now we're trying to rethink this about saying, hey, think about that bond portfolio. Let's reduce that a little bit and create an income or protected income asset class. So to your point, let's create some additional income that's protected, because you mentioned all these risks, sequence of return risk. Some people just recommend, just take 4% drawdown. Take 4% of your assets every year, draw them down, and that'll last you until you're dead. Well, if you did that before 2008 or 2020, your 401k was a 201k. So all of a sudden, that money you could draw down is dramatically reduced. They can't make up the income that they need for their essentials that you mentioned. So you want to have that guaranteed. And you mentioned inflation, political risk, all these risks out there. Insurance companies are good at managing risk. They can guarantee that income stream for you. And this gets into even Social Security. Social Security is designed on average to replace 40% of someone's pre-retirement income. So if you're thinking about that $70,000 of $35,000, that 40%, where does the other additional money come from? For some, it used to be a defined benefit pension plan, which is going away. And now you're looking at either personal savings, which might not be enough, or it's that 401k or IRA you have. And you're exactly right. How do you carve out some of that to create the income? Now, you can do a bridge. Like someone might say, well, geez, Ryan, I'm not sure if I'm going to live 30 or 40 years. I might, but can I do something that gives me benefits for 7 years or 8 years so I can take money at 62 through an annuity and then defer claiming Social Security at 70 and get that big monthly bump up that's guaranteed and inflation protected for the rest of my life? So it's walking through the strategies that help them have that income they need, to your point, for the rest of their life, at various ways to structure that.
And there really are, but we have to, as advisors, we have to wade through people out there saying that annuities are bad and you shouldn't have an annuity and don't buy an annuity. And here's the 8 common pitfalls of an annuity. And the reality is it doesn't matter. Okay. Because here's the way I look at it. Stocks are a tool. Bonds are a tool. ETFs a tool. Mutual funds a tool. Life insurance a tool. Private equity a tool. Dividend paying stocks a tool. They're all tools. Annuities a tool. So if my wife asks me, son, honey, go hang a picture in the hallway, I'm going to go down to my toolbox and I'm going to get a screw gun. I'm going to get a screw. Okay. I'm going to get a level because God forbid I hang that picture unlevel, right? And I'm going to measure it, do a tape measure to measure it out. But Jason, in that moment, I'm not getting the wrench or the pliers or the whatever else I need or whatever else is in there. But does that make the wrench or the pliers a bad tool? No, it's just for that particular job. They're not the right tool. And so I feel like a lot of people are out there having to wade through marketing material that makes them believe that their money should be invested the exact same way, all of it, and not using different tools out there or trying to use the same tool for all jobs.
Yeah, no, you're exactly right. And I love that analogy, the toolkit, because you're only as good as the tools you have, but one tool does not fit all. Even a Swiss Army knife has limitations of what you can use it for. But it is thinking holistically about your portfolio and what you're trying to generate and how you want to generate income is an important thing to think about. And I think with the annuities, one of the things, so the Alliance for Lifetime Income was started 8 years ago by the major insurance carriers who said, we're seeing this framing in the marketplace. The public hates annuities. They don't like them, right? So the goal for the Alliance for Lifetime Income and the Retirement Income Institute was to do research to change that narrative based on data and research. So you've probably heard the joke. If you go ask people on the street, Ryan, do you want to make sure that you don't outlive your savings? They're like, oh yeah, I want to make sure that, I have enough savings to last the rest of my life. Would you like to have a personal pension? Well, I'd love to have a personal pension. Would you like to have a paycheck in retirement? I would love a paycheck in retirement. Do you want an annuity? No. Well, I just described 3 things that it is an annuity. And I mentioned, do you know Social Security is an annuity? They go, really? I'm like, yes. So the way it's been framed, as you said, by some bad actors, but the media and some other financial advisors has really done some disservice to the public. And we've been changing that narrative now for 8 years. And to your point, there are so many products out there that you can sit down with somebody. It's not one size fits all. It really is talking to a financial professional about what is that client's needs and what products are available to structure the income they need in retirement that's guaranteed.
Well, and I think the issue too, Jason, is that people are, there's some old adages, right? Annuities have high fees. No, they don't. There's plenty of annuities out there that have no fees on them whatsoever. A straight income annuity has no fees. Okay. They're risky. How? Show me the risk in them. All right. Could the insurance company fail? That's a possibility. All right. But you're going to jump on this, and I know in a second, and we'll go back to it. But the likelihood of that, if insurance companies are failing, imagine what the banking system's doing. Okay. Stuff's gotten bad. If I die, the insurance company keeps all of my money. Well, that is true in an immediate income annuity. That's a fact. But there are other annuities out there that have residual value, okay, after you pass away, depending upon how much of the money in the annuity you used along the way, right?
Yeah, or survivor benefit.
Or survivor benefits is exactly right. Or I can't get my money out of the annuity. Well, that's not true. And so when you really start unpacking these things, you find out that at the end of the day, having a portion of your money in a guaranteed source to solve the retirement equation of how do you live the next 30 to 40 years without your paycheck and not run out of money or income in the process. An annuity is a great way to do it, but you just have to understand the benefits, the pros, the cons, and also understand there is no perfect tool out there.
Yeah. And Ryan, you made a good point. You're, to give you kudos, right? You're a good financial professional. If every professional came in when their client says, I don't want an annuity, and they asked why, and they said, well, I take my money back. Well, here's a product where you can get some back. Oh, I'm afraid they'll take all my money and there's no spousal benefit. Well, here's a survivor and spousal benefit. Here's this. If you walk them through their concerns, you would draw them to the product that fits their needs. and addresses their concerns. And I think that's a very important role for financial professionals today.
Well, and you know this. So what is the reserve system, if you will? Like if an annuity, insurance company A guarantees income for life, how do we know they won't go bankrupt or go out of business or fail or whatever?
Well, I don't think there's been a major insurance company failure in 100 years. So that's one big thing. Two, you have state guarantees. So the states basically have a system that regulates the insurance companies. They're very highly regulated, and they're required to keep large capital reserves to cover that guarantee that they're making to people. So when we say there's guarantees out there, is everything 100% certain? No. Is this 99.9999%? Yes. And I think people should be feeling comfortable that when an insurance company, a major insurance company, so the well-rated ones, guarantee your paycheck in retirement, your annuity payment, you can basically rest assured that's going to happen.
And I agree with you. And you can always diversify. I think the coverage limitations on the Guarantee Association. I don't call it a fund, by the way, because there is no fund. Okay. Right. That's not how that thing works, by the way. But I think it's up to $250 per contract, per carrier, per person. So if that's a concern for you, put $250 here, $250 here, $250 there, and make sure that they all meet your needs and wants, and you're in good shape. You don't have to worry about the insurance company failing from that standpoint. So let me ask you this. Social Security.
It's a big annuity.
Yeah. Will it be there?
So the answer to that question is yes. The real question is in what form and what capacity and what benefits can it pay? So there's this old survey that came out years ago that asked, I think it was millennials, do they believe that more millennials believed in aliens and Social Security will be there for them when they retire?
I haven't heard that. That's good.
When I was at Social Security and I'd be traveling, I'd be on the airplane and sitting next to somebody and, someone strikes up a conversation. What do you do? Oh, I work for Social Security. Oh, I won't get anything. Well, it's going bankrupt. So I think the first thing to tell people is Social Security is not going bankrupt, but it does face financial challenges because Social Security is right now paying out more in benefits than it collects in revenue, basically payroll taxes. And it's drawing down from the trust fund. When that trust fund is depleted, which right now for the retirement program is 2033, you combine it with disability, it's 2034. But once those trust funds are depleted, Social Security can only pay out what it collects in revenues for benefits, which basically means you get about a 20% haircut. There's a shortfall. And the question is, will Congress allow that? Social Security by itself cannot borrow money. Congress would have to do legislation to allow Social Security to borrow or draw from the general revenues. And so the question is, what format will Social Security be there? What form will happen by 2033 or at 2033? And that's I guess that's right now a $32 trillion question because that's the shortfall of Social Security, right? And we're all trying to figure out what this means for retirees. I don't think any Congress will let retirees take a 20% haircut overnight. The question is, how does that change over what period of time? Is it going to be more federal borrowing? Is it going to be higher taxes, means testing, a combination? And that's where we're not sure. But Social Security will be there. And this gets into the planning idea. The quote unquote worst case scenario is you see your benefits reduced by 20%. So if you're getting $3,000 a month, you're now going to get $2,400 a month. And then you plan that accordingly as a worst case scenario.
But here's what we do at Allied Wealth. All right. We try to eliminate worry everywhere we can. I can't get rid of all of it. Okay. But if you're so concerned about your Social Security benefits being cut out into the future, well, why don't we buy some Social Security insurance? And when I say that, people look at me like I'm crazy. And hey, listen, we're in 2025 today. Okay. So we've got 9 years of 2024. Why don't we buy a deferred income annuity? And let's find out what we need to put into that annuity. Grow your Social Security benefits out 9 years for COLA, okay? And cut them by 20%. And if they get cut by 20%, we turn on the income from that deferred income annuity, and guess what? You're getting the same amount of income.
Exactly.
Right? I mean, that's a way to do it. And if you don't use the deferred income annuity, you can take the lump sum value out of the annuity and do something else with it if you want to.
Yeah, or use that extra income for spending.
You can turn on the income and do more traveling, right?
Yep.
I mean, so it's not like it's an unsolvable issue. Yeah, it sucks that there's a chance that you were promised whatever number you see on your Social Security statement. Yeah, and you may not get that. That sucks. I agree with you, but it doesn't mean it's the end of the world.
Right, and you can plan. I mean, the old adage is people don't plan to fail; they fail to plan.
Yeah, and indeed. So let's talk about pensions for a minute. I didn't even know the Puerto Rico pension trust went broke. Tell me about what happened.
Well, it's more like Puerto Rico went broke. So in 2016, Puerto Rico was bankrupt. Congress passed a law, PROMESA, that restructured, and they have an oversight board now that does their financial management. And for people who are familiar with restructurings of cities, New York City had a restructuring board. Detroit recently had one. Washington, D.C. had one. It's kind of the same thing for Puerto Rico. What happened was their municipal employees, teachers, judges, firefighters, their pension plans had zero assets. So done, bankrupt, couldn't make payments. They issued what was called pension obligation bonds. So they basically said, hey, we're going to basically borrow money and pay 4.5% and we'll get 10% in the market. Well, that didn't work. So they didn't get the additional revenue from the bonds, couldn't pay the bondholders. So Puerto Rico itself restructured, and one of the things that came out of it was this new pension reserve trust that I am now one of the 5 trustees for and currently chair. And in the reforms, they closed the defined benefit pension plan for employees. So if you're currently an employee, you're still on it. New employees go to a defined contribution plan. But if you close the plan, Ryan, people who are currently working are paying for current retirees, who pays for the current workers when they retire.
Ponzi.
So what they did is they created this pension trust, which is me and 4 others in a marketing and a research team and investment team. We get money from the Puerto Rican government based on some of their contributions. So there's PAYGO that pays for current retirees. And then we get money every year in a trust that we then actually invest. And we invest that money. We're basically the piggy bank. And so as the PAYGO from payroll taxes starts declining, in about 8 years or 7 years, we'll start making up the difference. And we won't pay the pensions, but we'll pay the government so they can pay full pensions. So we make up that difference. And what makes us so unique is that we are literally independent. I have a 6-year term. I can't be fired. They can't come to me and say, please invest in a Puerto Rican golf course, hotel, resort, go put money in ESG. We do things based on the benefit of the trustees to maximize the return with the risk adjusted. We have a low discount rate we use for an investment portfolio, so it's very conservative, and we protect the money. And right now we've got about $5 billion under management. And when we talk to the Puerto Rican citizens, they have never seen $5 billion of real money before in a pension fund. And it's just heartwarming to see how you could do this in a way that secures it. And imagine if we had done with Social Security, instead of investing everything in treasury bonds, we did a diversified portfolio. So it wasn't the government borrowing from its left pocket to pay its right, but we actually had some assets that were managed like the government does its thrift savings plan for federal employees. You could have an independent system. If we had done that back in 83, the system would still be solvent today.
That's amazing. So can I ask you what type of investments you guys are making inside of that fund?
So yeah, basically most of it's passive. So if you Google Puerto Rico Pension Reserve Trust, you'll find us online. We are very transparent. We publish our quarterly investment statements so you can see what we're investing in, how much is going into it. But a lot of it's equities, bonds, international. It's a diversified portfolio. But we are heavily in bonds because we are trying to guarantee that income. And so we basically have more in bonds and fixed income assets, and some in actually equities for that additional bump you need for return. But it's all online. What I would say is don't follow our investment portfolio because it's not designed for an individual who's trying to save for retirement. It's designed to basically have a 4.5% to 5% return target to protect the money going in. So it's there for beneficiaries and they need it coming out. People who have just starting their careers need a higher risk portfolio tolerance than we have. But it's interesting to see because some pension plans don't always publicly list what they're investing in. We do. So everything's online at the Puerto Rico Pension Reserve Trust website.
That's really awesome because you took a situation that was lemons and made some pretty serious lemonade and a lot of people happy and gave them some financial security back. That's good. That's you're to be commended.
I'm very proud of the work we did. I was the first person appointed to the trust, and we had to stand up the whole thing from scratch. And I had a lot of help, but it was a lot of work.
That's really cool, man. What a great ending to an unhappy story, right? Well, tell me this, but so, what do we say to somebody who's, and you know as well as I do, because I follow the Insure Retirement Institute, I follow LIMRA, I'm a big fan of guaranteed income for life. But what do we say to people out there that are, in their retirement crisis, which we know people are underfunded in a lot of ways and they don't have guaranteed income. They don't have pensions. Somebody $500,000 saved for retirement, and that's about it. And they're maybe behind the 8 ball, maybe they're not. I mean, what are we telling folks? What do you suggest for folks like that?
I think for someone who's got $500,000, they're actually better off than a lot of people. So they should stop worrying, relax a little bit, talk to a financial professional, and see how to take some of that $500,000 and create additional income they could use for retirement. And part of that could be, like I talked about, a bridge annuity earlier. You may or may not need a lifetime annuity. What you may need is a short-term fixed annuity to facilitate some income in the short term so you can defer your Social Security claiming until age 67 or 70. That's one thing. And the other thing, of course, is get a handle on your spending. Have a budget. A lot of people don't sit down and actually do a budget, and it's very helpful to do it with a financial planner. And then think about your portfolio allocation again. What do you want? And then for 50, of course, if you have some income, you can do catch-up contributions for, retirement accounts.
So that's awesome. And I agree with you. And I like the bridge annuity idea. That's a really good one. I've not spent a lot of time with. We're trying to do a little bit longer with the annuities, but a bridge annuity is a great thing. And we talked about the you can start drawing off your portfolio at that point in time. But like, what do you typically see? Let's say I've got $1 million and I'm 65. I retire. I got no pension. Okay. What should a portfolio look like for somebody at that age? What's a good idea?
So this is where, I'll start with a rule of thumb and then say not one size fits all. So definitely talk to a financial planner, a financial advisor or professional afterwards. But I would say you should have something like a 50-30-20. So 50% should be in equities, 30% in bonds, and 20% in guaranteed income products. That creates some of the income you need on top of Social Security. That's kind of a starting point. And if you start with that, you still have then the equity exposure you need to help with inflation. You've got bonds, so you can do any kind of laddering you want with income, and you have that kind of protection as well to be a defense against market declines. And then you have that guaranteed income you've talked about so much, Ryan, that gives them protection that's guaranteed for their essentials. And that's kind of the bucketing, that framing helps with that kind of portfolio equity analysis and ratio.
And that's interesting. And that's a lot of what we do at Allied Wealth is we typically are a balanced approach between risk bucket and safe bucket. We like the safe bucket to provide guaranteed income for life. And oftentimes too, for some folks out there, the husband wants to take more risk than the wife does, right? So the wife just wants to know the income's there, so we can take the safe bucket and put the money to work safely, right? Getting the income they need. And the husband could take a little bit more risk in the risk bucket. It's kind of interesting how that works, right?
So this is your interesting thing about the behavior stuff. So, an economist will tell you that a dollar is fungible. It doesn't matter where a dollar comes from, a dollar is a dollar. But that's not how humans think, right? Humans think in what they call mental accounting. They bucket things. When they save, they have that Christmas savings account. So they have the passbook savings for Christmas. They had savings for travel. They have savings for education. They have savings for retirement. They have rainy day savings. We like to bucket. So you're great to talk about buckets and what that actually looks like. And this gets into then what do you do with the protected income? What it does is, one, it reduces the risk on that equity portfolio. And there's two things that's important about having that protected income. One, you mentioned that a husband may want to take on more risk. You are now, because you have that protected income, you can take more risk with that equity. And so if somebody even has FOMO, right, fear of missing out, and they come in and say, Ryan, I want to invest in crypto. You go, oh, I'm not sure, but because you have protected income, we can take a little bit of that, and if you want to gamble that, we can do a very small sliver so you don't have fear of missing out on something. That's one aspect. The other, this is something for financial professionals to consider, when retirees are so reliant on that equity portion for income and retirement, they're not comfortable, they don't sleep well during market panics, and they panic. And what happens is the market starts going down, and they call their advisor and say, sell, sell, sell before it goes lower. But of course, that usually is selling near or at the bottom. For those who have more protected income, the concept is stay the course. They know that they have an income protected they need, the budget they need to actually pay for the expenses. They can let that equity portion ride the market volatility, and they don't call and sell at the bottom. They stay the course. And that's an important feature as well.
Yeah, it really is. And that's a conversation we have too with folks is, listen, we've got your portfolio on the left here on the risk side. It's this, 60, 40, 70, 30, whatever it is. And yes, the annuity that you're in is providing guaranteed income. The base didn't make any money last year. It was flat. Not to mean it won't make money in subsequent years. And you're not happy with that. Yet it's still providing a guaranteed income. Okay. So if you want to get out of the annuity, you can, but I would have to ratchet your risk on your risk bucket way down, because now we're depending upon those dollars to produce your income. And the last thing you want to have happen is a major market crash occur. And what I think people, the behavior aspects of this is, when you're saving for retirement and you're still working, you can afford to take more risk up to a point, by the way. Okay. But once you retire, the deeper you get into retirement, the more emotionally tied to the value that you see in your statements of your portfolio you become. And if that value starts dropping, your emotions go through the roof and you start going, oh my God, did I make a mistake? Should I have not retired in the first place? Have we spent too much money? What are we going to do? Am I have to go back to work, go be a greeter at Walmart, go work at Home Depot, whatever it is, because of the emotional aspects of that. And I just feel like the people that we serve that take advantage of guaranteed income, and they, sure, they'll call me, hey, Ryan, the portfolio's down 5-10% and the market's down 20%, for instance. What's going on? I'm like, guys, listen, I can't make the markets go up. I can't do it. Okay. But I can guarantee you this, the market's going to go up. The market's going to go sideways and the market's going to go down. It can only do those three things. All right. Regardless of what happens with that stock market, because we were smart with a portion of your dollars between your Social Security and your annuity income, you guys will never, ever have to worry about your paycheck again. And, Jason, when people start to realize the benefits of that, I wish I could get like recordings and do YouTube channels or whatever and billboards for people to be on the other side of that. And the reason why I say that is people don't understand the experience they're going to have with guaranteed income until they have the guaranteed income in a down market.
And the other thing too, this is where you were alluding to as well, is people, an economist thinks, like, what is money for, right? To an economist, money's for spending. Basically, even savings is just delayed, deferred consumption. You save money today to spend it tomorrow. So telling people, look, you've been saving all your life. Now you need a spending plan. The plan is the key thing, right? It's income is the outcome in retirement. We're going to give you that spending plan, the projected income you need to have that spending fit your plan and to match with the down markets. And that gives you the comfort and security you need. And I think that's a really good framing, because people are afraid, again, of spending out of savings, but they're okay spending out of income. And what we've done with additional research at the Alliance for Lifetime Income and the Retirement Income Institute is we found that people who have more protected income actually spend more in retirement because they're not tapping that equity. And if they didn't have the annuity, they were afraid of tapping their equity and they didn't spend enough. And so now you're giving them that license to spend, is what we call, by having that protected income and a higher budget constraint in retirement.
Yeah, it's so interesting. And we have so many just opponents of this. And it's just mind boggling to me. I don't think that someone today makes it as long as they need to without having some sort of guaranteed income in addition to Social Security. I don't see it happening.
Well, and that's the other thing too, is this is another just quick anecdote. When I was at Social Security, I would go visit field offices because you want to talk to real people. DC is definitely a bubble. Let's be honest, right? This is a bubble if there ever was one. So you go talk to real people and, I'd ask them why you're here. I'm claiming Social Security. How old are you? And one of the things that really surprised me is even for those who understood they were getting a reduced monthly benefit at age 62 and were just adamant that they wanted it today, I said, fine, I understand. And I would ask them, how long do you think you're going to live? And a lot of them generally would say, I'm 62. I think I'm going to live till about 82 or 84 years old. Okay? And I say, great. So you have enough income then to last you 20 plus years in retirement. They'd pause and say, no, I said I'm living to, and then the light bulb went on. Somehow them thinking they were going to die at 82 did not in their mind equate to needing 20 years of income, 20 years of saved up assets to fund 20 years of retirement. That number 82 seems more reasonable than saying I need 20 years of a paycheck in retirement. And that made them think, oh, maybe I should delay claiming Social Security. So again, how we frame this is very important.
Yeah, it really is. And just, there should be ways that people can be communicated mathematically, the timing of Social Security, the timing of distributions of your portfolio, the timing of when you actually retire, when you could afford to retire. And quite frankly, that's what a good planner does at the end of the day, right? When we do planning at Ally Wealth, Jason, we can take people through a cash flow model, and we have to replace the cash flows you have right now with, once you leave your paycheck behind, how do we replace those cash flows, right? Well, one of the things we can do is eliminate cash flow draws like a mortgage, right? Car notes, credit card debt, all that sort of stuff. Another big one, by the way, that people overlook is that when you stop working and stop saving for retirement, you stop writing a check to yourself for that 401k plan each month. So that goes away. You stop paying payroll tax, 7.65%. A lot of people overlook that, by the way, right?
Yeah.
So, you kind of start backing into this stuff. And then what we want to do is move over to, okay, how do we get you to a long-term chance of success using Monte Carlo analysis, for instance, right? And it's always fun because we try to get people to the 100% chance of long-term success. And I go, that's too good. Like, well, what do you mean that's too good? I'm like, you need to be at 85%. If I can keep you at 85% chance of long-term success, you are living a great life. If you're at 100% chance of long-term success, your kids are going to wind up with too much of your money. Right? So it's interesting. And the planning that we do really speaks to helping people solve that retirement equation and live the best life they possibly can with the resources they have to work with. And I'm so grateful for all you do with all the stuff that you guys do, LIMRA, or Insure Retirement Institute, because we apply so much of those concepts and ideas to the planning we do at Allied Wealth and are able to serve a lot of people as a result.
I appreciate that. And a plug, for anyone who's interested in the research we have, everything's available to the public on protectedincome.org. That's our website for the Alliance Lifetime Income and the Retirement Income Institute, protectedincome.org. Use the resources that are available for consumers, financial professionals, media, policymakers. Everything's available without charge.
That's awesome. Well, folks, that'll do it for today's episode. I can't thank Jason enough for joining us. I got a lot out of this. I hope you do too. And Jason, thank you so much for being on the podcast today.
My pleasure. Thanks for having me.
Subscribe to Redefine Retirement on YouTube, Spotify, or wherever you listen to podcasts.